In today's video, we'll be discussing the financial instrument of swaps. Swaps are nothing more than exchanges of payment streams, or cash flows, in the future. Companies often use swaps as a tool for risk management and engage in swap transactions with other companies. Swaps can be applied as exchanges for any objects that generate cash flows. However, the two most common types of swaps are interest rate swaps and currency swaps. But how exactly does a swap transaction work? We'll explore this next by looking at a specific example of an interest rate swap. There are two basic forms of interest rates. Interest rates can either be variable, where the rate is tied to a reference interest rate like the Euribor, which represents the interest rate at which banks lend to each other. This interest rate fluctuates daily, making it variable. On the other hand, interest rates can also be fixed, where the rate is set and remains constant throughout the entire term. So far, so good with the theory. Now let's look at the following situation. Bank A has lent money to Company A and agreed with Company A on an interest rate that includes a fixed rate of 1% plus a variable component tied to the Euribor. Since this interest structure includes a variable component, the interest rate can be considered variable, as its amount can change over time. Bank B has also lent money to Company B, but has agreed with Company B on a fixed interest rate of 2%. In recent quarters, Company A has shown highly volatile business results, which was poorly received by shareholders. To increase planning accuracy and avoid unpleasant surprises, Company A now prefers not to deal with a variable interest rate anymore, as it is difficult to plan with, but instead favors a fixed interest rate that allows for better and more predictable planning. Bank B, however, after an internal analysis, expects that the Euribor, the reference interest rate, will rise significantly in the future. Unfortunately, Bank B cannot benefit from this, as it is receiving a fixed interest rate that does not change with the reference interest rate. Bank B would therefore prefer not to receive a fixed interest rate anymore, but rather a variable interest rate. Bank A and Bank B thus have opposing interests regarding the interest rates. So, the two banks decide to enter into an interest rate swap transaction. The amount of the interest rate swap is based on an agreed sum. The two banks agree on a swap amount of $2 million. The interest rate is then calculated from this amount. Bank A now pays Bank B the variable interest rate, that is, 1% plus Euribor, and in return receives the desired fixed interest rate of 2%. Since Bank B pays the fixed interest rate, Bank B is referred to as the payer in technical terms, while Bank A, which pays the variable interest rate, is referred to as the receiver. Now let's see how the swap payments behave when the reference interest rate changes. At the first settlement date, the Euribor in our example is 1.5%. Banker A has to pay Bank B 1% plus 1.5% Euribor, which totals 2.5%. Of the underlying $2 million, this amounts to $50,000. And Bank B pays Bank A the fixed 2%, which totals $40,000. In this case, Bank B has initially made the better deal, as it pays less than it receives. But in the next settlement period, the Euribor drops to only 0.5%. Bank A now pays Bank B only $30,000, that is, 1% plus the 0.5%. Bank B, in turn, still has to pay the fixed amount of $40,000, so now Bank A has the upper hand. This process continues throughout the duration of the swap. Ideally, both banks benefit from the swap transaction. We hope this video has helped you understand the topic of swaps. See you next time and have a good one.